This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
Trick or treat? Many expected the worst, but October turned out to be a big treat for investors.
Bubble trouble with stocks in very high territory. Some savvy investors are starting to use the dreaded B word. So what should you do? We have the bull and bear cases for your money.
And no room for error. We know many people are one or two paychecks away from bankruptcy. But did you know there are major cities running perilously close as well? The frightening names and numbers ahead. We have all that and more for this Halloween, October 31st.
Good evening, everybody, and happy Halloween. It is the final trading day of October, a month that historically has not been a very good one for stocks, but this year, October doesn't look so scary after all. Today, stocks moved in a very narrow range for most of the session, but traders did seem to get spooked in the final hour and they sold off. In the end, the Dow was down 73, NASDAQ off nearly 11, and the S&P fell 6. But for the month, it was a good one for the bulls. The Dow up about 3%, the NASDAQ up about 4%, and the S&P 500 up better than 4.5% or thereabouts. And with the month of October coming to a close, the nights are colder, the days are shorter, and investors apparently afraid of very little for now.
One by one, the ghouls that might have ruined October for investors were sent packing. Ben Bernanke didn't start yanking on the monetary purse strings as some expected. The government closed, but then reopened, and everybody got paid, employees and creditors alike. Earnings a mixed bag with enough treats to balance out the tricks, and the economy's okay.
The economy's still growing at roughly 2%, right? So I think it is fairly resilient, and if we didn't get in our way, we would have actually been growing a little bit faster.
All in all, a pretty good recipe for stocks in a month that's earned its reputation for being unfriendly to equity investors. There was October 1929, of course. The market fell more than 20%, ushering in the Great Depression. There was 1987. The Dow crashed almost 23% in a day. And finally, 2008. At one point in that dark month, the Dow was down 28% for the month, despite the index's biggest one-day gain ever, more than 936 points on October 13th. This year, of course, it's different. Record highs for the Dow, up 3%. The S&P 500 up almost 5%. The Russell 2000 nearly 3% higher. And NASDAQ, with a gain of 4% this month, is higher than it's been in 13 years. Investment trick or treat?
Try not to think about the levels because then it scares you.
I'm getting a little bit more nervous. I'm kind of fighting the greed demons.
So what happens from here? Well, that naturally is anybody's guess, really. Seasonality, though, is on your side. Typically, the markets go higher in November and December. Then again, with the S&P 500 already up 23% or more this year, maybe there's a reason to be scared of heights.
And those lofty levels have some Wall Street pros scared of bubbles, market bubbles. That's when investors drive up stock prices way above their true value. Remember the dot-com bubble? Well, there's been a lot of talk this week about the risks of a market bubble. Is it just talk? Here's what some big-name investors are saying.
I think the markets are bubbly. All asset prices are bubbly. Bond prices, stock prices.
At this point of time, the stock market is somewhat bubbly. It has a high cape, but we can still find low cape sectors in the market.
There is that disconnect and that sense of a bubble brewing, right? Although today, look at the market. We're essentially flat, maybe up marginally, right?
So who's right and what should you do with your money? Let's get the thoughts of two fund managers. One's a bull, the other's a bear. The bull, Vince Lowry, CEO of Revenue Shares and VTL Associates, will make his case to Tyler, and I'll question the bear, Uri Landesman, president of Platinum Partners. Gentlemen, thank you so much for joining us. Uri, let me begin with you. So much optimism in the markets right now. Are we at risk of a bubble? Why are you so bearish?
Yeah, well, I'm bearish because I think prices are way ahead of themselves. I think that they're inflated because the safety net that Bernanke and the Fed have pitched under us for a number of years right now This too shall pass. We're at a point in the market where the market wants to hear bad news because that means the Fed is going to hang around longer. I think that that's the opposite way we should be looking at things. The market is not pricing in any chance of bad news, and I think that there's a lot more room to the downside here than to the upside.
All right, Vince, answer Uri there if you might, and specifically address why stocks have been rising so much when the economy and earnings aren't rising nearly as quickly.
Sure. The only bubble out there is in the bond market today. The stock market is nowhere near a bubble. Right now, you can buy the S&P 500 at $1.60 roughly in capitalization for every dollar in revenue. To put that into perspective, the bubble of 1999, you were paying about $2.49 to buy the S&P 500. Now, that was a bubble. This is nowhere near a bubble. The long-term history is about $1.50 when you included periods of the 70s with inflation. Non-inflationary periods, $1.25. But when interest rates were at 6%, that was considerable. Now we're at a 10-year around 250. But the most important thing, the thing that's been studied over 100 years, is that when you have a positive sloping yield curve like this, especially one where you have short-term rates, 250 basis points below the 10-year that everyone studies, that's extraordinarily bullish for stocks. Although revenues are growing slow, we've detected in the last couple quarters that they've moved from growing on average over the last 2 years by 1.8 to 2.8%. And when you consider that for the last 5 years we've been in a structured bull market and they've been cutting costs, if those revenues rise up to the normal of 5 to 7% in the recovery, it's Katie Bar to do it for the stock market. If you're sitting on the sidelines listening to these bears, you're going to lose out.
Okay, Vince, let's turn back to Uri and get your response to what Vince is saying. His indicators are pretty much showing that things are bullish. A lot of cash on the sidelines, he's saying. Where's that cash going to go? Probably in the stock market, right, Uri?
Well, no, I don't really think so. So first of all, if the lead point in your argument is that this is not a bubble, and that's why we should be buying stocks, that's a fairly weak argument. I don't know which country Vince is living in, but in the one I'm in, what I'm seeing is a vast majority of America actually doing very poorly. So what we have is an economy that's giving the illusion of being okay, but actually when you look at it, it's completely bifurcated. And about 90% of Americans are actually living below their means and having less disposable income than they used to. This is a long-term, very great drag on the economy, and I don't see strength from the upper 10% and from the enterprise dragging up the bottom. And so I think this is a market that's ignoring a lot of warning signs out there and will react accordingly when people get a little more sober.
All right, Vince, quickly,
let's
get sober here.
Warning signs are out there. I don't know what warning signs are out there, but there's no statistical data to call for a bubble in the stock market. It's just not there. We're used to, during the previous 10 years, growing our revenues in the S&P 500 as a measurement around 6 to 7%. Now we're down to 2%, so we think the world's falling apart. We've got people running around worried to death. Don't be worried. There's a lot of good things in place. All we need is some growth. Maybe some of these people in Washington start some growth-oriented views of the world and provide some more growth-oriented economic behavior down there. And I am telling you that's all you need for a very big bull market that I think is going to go for another 3 years.
Well, there you go. There's a bold call. Uri sees it the other way. That's what a market's made of, people with different opinions there. Vince, Uri, thank you very much for being with us tonight. Well, while the U.S. dollar gained strength today and stocks floated downward, gold prices plunged. They tumbled more than $20 an ounce this Halloween day. Sharon Epperson has been looking into that spooky move.
Gold prices extended the decline in the session after the Federal Reserve's meeting as traders tried to parse through every word of their statement. They're trying to figure out when the Federal Reserve will actually start tapering its bond buying program. But traders are also watching some technical levels for gold very carefully. Here in the month of October, we've seen gold prices rally some $100 in about 10 days' time, getting to a high of about $13.55 an ounce. Now, gold was unable to maintain those highs, and traders say that's when some profit taking set in, and we're looking at perhaps a downward trend now in gold prices as we see prices getting below the $13.25 level. The key determinant in the next couple of days will be what happens to gold in terms of retail demand and physical demand. It is the Indian wedding season and often a time where there is strong physical demand for gold. We're also looking at ETF action to see what the largest ETF, the GLD, does in terms of investor appetite for gold in the coming days. Those may be the key determining factors on where gold prices go next. For Nightly Business Report, I'm Sharon Epperson.
Gold wasn't the only commodity falling today. Oil prices closed at a 4-month low, $96 a barrel. And just today, Exxon Mobile, the world's biggest publicly traded energy company, reported that profits fell 18% last quarter, even though it managed to earn nearly $8 billion. That helped Exxon Mobile become the biggest gainer in the Dow. Its stock rose almost 1%. But year to date, the company is one of the weakest performers in the index. Bob Pisani drills down on the numbers.
Oil giant Exxon Mobile reported earnings and revenues above expectations, but earnings were lower than the same quarter last year because profit margins on refining operations, primarily gasoline production, were much lower. The problem is growth. When you're as big as Exxon, it's tough to grow. Demand is weak, and the supply of oil is strong, thanks to abundant new discoveries of oil and natural gas in the United States.
This is a company that's increasingly going to struggle for growth. In fact, there's going to be no production growth next year and only 2% production growth for the next few years.
On top of that, production costs are rising worldwide. Another issue for big oil, finding enough new oil globally to replace what they lose each year. Exxon loses roughly 6% of their production each year. To replace that, they have to find more oil, often in politically unstable parts of the world or in a more difficult geological environment. Little wonder that Exxon's stock has been stuck in neutral all year, up only 2% in a year when the S&P 500 is up 24%.
This is the third worst performing stock in the Dow Industrials this year, so it is difficult to get too excited about it.
All the growth in energy stocks are in smaller companies that are part of the fracking revolution in the U.S., where companies like Pioneer Natural Resources and service companies like Halliburton and Schlumberger have had huge returns this year. Faced with slow growth, many investors are agitating for Exxon to return more cash to shareholders through a higher dividend or to buy back more stock. Today, Exxon maintained its buyback program, but did not increase it. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Well, the Obama administration has called in some very powerful exterminators to kill the bugs in its healthcare.gov website. Experts from Google, Oracle, and Red Hat are now working with the firms that developed the struggling online marketplace, trying to ensure stability and security for the millions of health insurance shoppers.
For the first time in 5 years, the federal government has run a budget deficit that's below $1 trillion. Thanks to those cuts in the sequester and higher tax revenues, the budget shortfall for 2013 is $680 billion. That's the lowest since 2008. And coming up, cities that have 1 or 2 days of cash on hand left. The ramifications coming up. But first, a look at how international markets fared today.
Debacle of the day. That is where we start tonight's market focus, and why not on this Halloween? Ariad Pharmaceuticals, the stock pummeled after the company suspended sales of its blood cancer drug, Iclusig, barely 2 weeks after it stopped an ongoing trial of the medicine over safety concerns. The stock down almost 45% today. And take a look at this next chart, down 88% for the month. And ding dong, Avon falling. The shares tanked after the beauty company reported a big earnings miss. A drop in North American sales and weakness in emerging markets threatened the troubled company's turnaround plan. World's largest door-to-door cosmetic seller also warned its numbers will be hurt by a larger than expected fine from the SEC to settle a bribery probe. The stock dropped almost 22% today to $17.50. More readers paid for the New York Times, boosting the media company's revenue. The Times still reported a net loss after selling the Boston Globe. Overall sales did beat forecasts. Gains in subscription revenue offset a decline in online ad sales. The stock was up a fraction today, but it is up 62% so far this year.
Expedia stock soared after the company reported quarterly profits much higher than estimates and revenues also better than expected, up 17%. The online travel agency said a referral system from TripAdvisor improved, helping the company's bookings. The stock popped 18% to almost $59 a share. Growth overseas and an increase in people paying with plastic helped MasterCard's bottom line. The world's second largest credit card company posted a 16% rise in revenue. On the day, MasterCard fell about 1% to $717. And AIG reported earnings after the bell that beat estimates, but revenue came in light. Strong growth in its property and casualty business helped the insurer this quarter, but investors couldn't ignore the revenue miss. So shares fell a fraction to $51.65 and continue to fall in after-hours trading.
Well, everybody knows about Detroit's bankruptcy, but a new study of U.S. cities' finances reported in today's Wall Street Journal indicates that many of the 250 largest U.S. municipalities are perilously close to running out of cash. The median amount of cash on hand was equal to just 81 days of typical operating expenses. A city emergency requiring police and fire overtime could consume much of that in a matter of days. Some of the cities with the smallest cash cushions: Shreveport, Louisiana, with 10 days, Chicago with 8.7, New Orleans with 2.5 days, and Fresno with less than a day's worth. Here now to explain why the cities are so cash-strapped is Kil Huh. He's Director, State and Local Fiscal Health for the Pew Charitable Trust. Mr. Huh, welcome. Good to have you with us. How did cities get in this perilous state, and how bad is it?
Well, cities are still challenging, have many challenges ahead. They're still recovering from the Great Recession. Their revenue bottoms hit much later than the state and federal governments, which took place in 2009, and they're still struggling to get back on solid fiscal footing.
Why did their revenue hit bottom later?
Well, it's a function of the property tax. The property values are still struggling, as well as the lag in assessed values. And in addition to that, the state and federal aid was also cut during that time as well.
You know, Kil, I was so surprised to see cities like Chicago, New Orleans on this list, very close to running out of cash over the next couple of days. Is it possible they could become the next Detroit and go bankrupt? How bad is the situation?
Well, they're not necessarily running out of cash. What the studies measured was the fiscal cushion that they had, the reserve funds or the rainy day funds that they had in order to cope with emergency. That said, they are still struggling. But bankruptcies are very rare. I don't think you'll see Chicago or Shreveport, Louisiana become the next Detroit. Bankruptcy is often a measure of last resort, and it's something that most municipalities try to avoid.
You know, I read in the article that they recommended that Fresno, for example, should ideally have something like $10 million in an emergency fund. What is the typical cushion that a city you would recommend should have on hand to make sure that it can weather, for example, a weather emergency?
Well, every city is different, and what they need in terms of reserve is going to vary from city to city. But typically, the reason why cities are in the position they're in is that they had to tap those reserves during the worst of the fiscal crisis for these cities. And when they tap reserves, they often cut spending, letting people go, such as police officers, firefighters, and sometimes administrators. And then, when that wasn't enough, they raised taxes. So cities had many tools that they utilized to get through the worst of the Great Recession and the fiscal aftermath, but they're still recovering.
So how do cities get healthy again? We know that in Washington there's budget problems there. That trickles down to the state finances, and then of course it goes to cities. So how do you get out of this mess? And the economy's not growing much anywhere.
Well, I think you hit on a key point. Cities have their role in ensuring that they're on solid fiscal footing, but at the same time, they also need the economy to start growing again too. And part of what the states need to do is also think about the aid that they want to provide their localities. The level of money that often is given to states, which is typically about cities rather, which is typically about a third of their budgets, have dwindled and are nowhere near pre-crisis levels.
All right, Mr. Huh, thank you very much. Kil Huh is Director of State and Local Fiscal Health at the Pew Charitable Trusts.
Now, on the flip side, some cities and towns are doing better than others, and that's thanks to the housing recovery. As the landscape levels out and more traditional factors once again play in home buying and selling. A new survey lists the top 10 turnaround towns. Diana Olick takes a look.
As if Boston doesn't already have enough to celebrate, add to the list one of housing's top 10 turnaround markets.
There's different employers that are wanting to start new businesses in Boston, which is a great sign.
A Realtor.com survey took median home prices, supplies of homes for sale, and days on market to come up with its quarterly list of the top 10.
The biggest change that we're seeing just on our list is that the state of California really had saturated the top 10, and those cities such as Oakland, San Jose, Sacramento have all really sort of gone through the recovery process, and now we're seeing other communities and cities move up to the top 10 and top 20 list.
Topping the list is Detroit, a market decimated by the auto industry implosion well before the rest of the nation saw any cracks in housing. A sharp jump in prices and selling speed pushed it to the top spot, but critics say other factors still weigh on Detroit.
When we look at the Midwestern markets in general, there's strong long-term demographics to out-migration that don't bode well for the long-run health of many of those markets, as opposed to the coastal, Sun Belt, Western kinds of markets where there's a lot more in-migration.
Detroit is riddled with foreclosures, while the nation as a whole saw completed foreclosures drop 39% in September from a year ago, according to CoreLogic. And judges are not involved in the foreclosure process in Michigan, unlike in so-called judicial states where they have slowed the process dramatically. The top 10 list, as well as the housing market in general, are becoming increasingly volatile. Rising home prices, rising mortgage rates, and uncertainty here in Washington over the debt limit and the budget deal have and continue to take a toll. For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about the top turnaround towns, go to our website at nbr.com.
And just ahead, something really scary, and it's not good for your sweet tooth or your wallet. But first, a look at commodities, treasuries, currencies on this Halloween day. A few weeks ago, we gave you the estimate. Now it's official. If you're among the 58 million Americans receiving Social Security, your payments will go up next year, but not by much. Benefits will rise 1.5% in 2014. That's the smallest increase since automatic cost of living adjustments began in 1975. Now, that's because the number is tied to consumer inflation, which barely budged over the past year. Now, the increase averages out to about $19 extra a month.
Here's some good news for air travelers. If you like using electronic devices, federal regulators are easing up on restrictions once you board a plane. You will soon be allowed to read, play games, and watch movies during landing and takeoff. But you still can't make cell phone calls. Delta and JetBlue say flyers might be allowed to use their iPads and Kindles as early as tomorrow.
And finally tonight, it is, of course, Halloween, candy's big day, and the ghoulish price of chocolate is enough to scare just about anybody. Cocoa prices have shot up 20% this year. Jane Wells tells us why.
Trick or treat! Kids, get ready for something really scary. Candy prices could go higher. The reason? Chocolate. Cocoa prices are up 20% this year, a combination of poor weather in Africa, where most of the world's cocoa is grown, and rebounding demand.
We think this will be the first year in 2013 where the level of global cocoa demand exceeds production for the first time since 2009.
You probably won't see price hikes soon. Hershey's contracts cocoa prices as much as 2 years in advance. But retailers like Costco say demand is so strong, some players may have to buy in the current market. Costco says the cost of a ton of cocoa has risen from $2,200 to $2,700 and is running through packaged chocolate faster than anticipated. And at Ralph's, owned by Kroger, sales of candy are up this year, but so far prices are not.
Certainly the mixture is always very popular, but I'll tell you, chocolate is still king. It really is the best seller in our candy department.
Now, no one is suggesting we're going to run out of chocolate, at least not yet. And while Americans are always being encouraged to have a healthy Halloween, that's no fun. In fact, one company is mocking the very idea.
Who likes Halloween candy?
Me! Crest has created a viral YouTube hit with a video where kids are tricked into eating treats made from healthy foods like vegetables.
Mine tastes like broccoli. Yuck!
The reactions are unscripted and, a warning, sometimes too real. Crest parent company Procter & Gamble debated whether or not to show a little girl named Adriana spitting up her artichoke buttercup.
I think the reason why we kept it is because right after that, she very kind of comfortably says, I just threw up.
I threw up. You threw up? Okay.
I think in the context of the spot is the one where you were kind of getting a lot of chuckles. So we decided to keep it.
Plus, her parents were nearby. The video may or may not sell toothpaste, but it certainly proves that Americans are crazy for cocoa. And no matter how much it costs, you can't have Halloween without it. For Nightly Business Report, Jane Wells, Los Angeles.
Well, I'm
that
crazy.
poor little kid. I feel awful for her.
I'm crazy for chocolate, and I don't care what the price is.
You'll pay.
That is my sweet
You'll
tooth.
pay. My son is being a police officer. I'm going to run home right now and catch up with him.
Okay. Have a happy Halloween, everyone. That's Nightly Business Report for tonight. I'm Susie Garrow.
And I'm Tyler Matheson. Thanks so much for joining us tonight. Have a great evening, everybody. We'll see you back here tomorrow, Friday night.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our Dividend Stock Advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
I'm Susie Garrow with a Nightly Business Report news brief. It's the final trading day of October, a month that historically has not been a very good one for stocks. But this year, October doesn't look so scary after all. The Dow rose 3% this month, and the Nasdaq up 4%, and the S&P gained more than 4.5%. Now, today on Wall Street, the Dow lost 73 points, the Nasdaq fell nearly 11, and the S&P down 6. The Obama administration has called in software engineers from Google, Oracle, and Red Hat to fix its healthcare website. And good news for air travelers. Federal regulators will soon let you use electronic devices on board planes. You will be able to read, play games, and watch movies during landing and takeoff. But cell phone calls still off limits. Be sure to tune into Nightly Business Report right here on your public television station.